Welcome to the world of double-entry bookkeeping. Ever wondered how businesses keep track of their finances with precision and accuracy? Today, we dive into this age-old system that forms the backbone of modern accounting. In double-entry bookkeeping, every transaction has two sides, a debit and a credit. This method ensures that the books always balance, offering a clear and reliable snapshot of a company's financial health. Think of it as a never-failing scale, where every action has an equal and opposite reaction. Debits on one side, credits on the other, a seamless dance of numbers that tells a story of economic activity. By the end of this guide, you'll grasp the fundamental principles of double-entry bookkeeping and be equipped to navigate the financial landscape with confidence. Let's begin this journey together. Have you ever wondered what lies at the core of modern accounting practices? Enter double-entry bookkeeping. This system, dating back to the 15th century, is pivotal in ensuring financial accuracy. Each business transaction is meticulously logged in two accounts, one debited, the other credited. It's like a seesaw, maintaining balance as one side rises, the other falls equally. This meticulous approach not only traces money's origins and destinations but also serves as an immediate error-checking mechanism. Today, double-entry bookkeeping stands as the unparalleled global standard for financial record-keeping. Ever wondered why double-entry is crucial? It's a built-in error detective, flagging issues when debits and credits don't align. This system offers a complete financial snapshot, showcasing gains and losses for full transparency. With accurate records, decisions are based on reliable data, leading to better business judgments. Double-entry isn't just about numbers, it's a powerful tool for precision and insight. In the world of business, transactions revolve around 5 key account types. Each category plays a vital role, with distinct rules for debits and credits guiding their movements. Assets encompass resources owned by the business, from cash to inventory and buildings. Liabilities represent what the business owes, such as loans and accounts payable. Equity reflects the owner's stake, including capital contributions and retained earnings. Income captures revenue from operations, like sales and service fees, while expenses account for costs like rent and salaries. Understanding these pillars is pivotal for financial clarity and strategic decision-making. Ever wondered how businesses keep their financial records in check? Enter the accounting equation, the rock-solid foundation of double-entry bookkeeping. Assets equal liabilities plus equity, a balancing act that ensures every business possession is funded by borrowed money or owner investment. Picture this: when a company buys equipment with a loan, both sides of the equation rise equally. And when debt is paid off with cash, both sides decrease in harmony. This equilibrium guarantees that your financial records are not just numbers on a page, but a true reflection of your business's financial health. Balance is key. Every transaction has a matching impact. Mathematically sound and crystal clear, the accounting equation is your trusted ally in the world of finance. Takeaway: the accounting equation, balancing assets, liabilities, and equity for financial harmony. Ever wondered about the mysterious world of debits and credits? Well, they're simply the left and right sides of an account, no good or bad connotations attached. Debits, always on the left, boost assets and expenses but reduce liabilities, equity, and income. On the flip side, credits go on the right, increasing liabilities, equity, and income while decreasing assets and expenses. Remember, for every transaction, debits and credits must balance. It's the magic of double-entry bookkeeping. Just like a seesaw, one side goes up, the other comes down. A dance of financial harmony. Ever wondered how to navigate the world of debits and credits in accounting? Let's break it down by account type. Equity and income decrease with debits and increase with credits, while expenses behave the opposite. Liabilities decrease with debits and increase with credits, just like assets, remember, they both increase with debits. This fundamental pattern governs all journal entries. Think of it as a roadmap guiding your financial transactions. Keep this in mind as we delve deeper into the intricacies of accounting principles. Understanding this framework is key to mastering the art of journal entries and financial record keeping. In the world of modern accounting, the golden rules have adapted to the 5 account types. Let's simplify the process. Debit what comes in for assets, credit what goes out. For liabilities, it's credit what comes in, debit what goes out. Equity? Credit what comes in, debit what goes out. Income? Credit all income, debit all income reductions. And for expenses, it's debit all expenses, credit all expense reductions. With these rules as your guide, navigating transactions becomes a breeze. Remember, clarity in accounting begins with mastering these modern golden rules. In the world of accounting, a journal entry is more than just a record, it's the heartbeat of financial transactions. Here, double-entry bookkeeping breathes life into numbers, capturing each transaction's essence. Picture it: dates, affected accounts, debits, credits, and a snapshot description, all in perfect harmony. Sequentially arranged, these entries form an unbreakable audit trail, a financial diary chronicling every business move in precise detail. Your journal is the storyteller of your business's financial journey, speaking volumes in the language of numbers and balance. Ever wondered how a journal entry is structured? Let's break it down. The date marks when the transaction took place. Account titles are listed with the debit account first and the credit account indented below. Debit amounts go in the left column next to the debited account, while credit amounts are in the right column next to the credited account. A brief description in parentheses explains the transaction. Remember, credit entries are always indented for clarity. By following this format, journal entries become easier to interpret at a glance. Imagine this: your business makes a straightforward move, buying office equipment for $5,000 in cold, hard cash on January 15, 2024. As a result, your equipment asset increases by $5,000, while your cash asset decreases by the same amount. Remember, assets rise with debits, so we debit equipment, and assets fall with credits, leading us to credit cash. The journal entry on January 15, 2024, reflects this transaction neatly. Equipment is debited $5,000, while cash is credited $5,000. The balance is maintained, with debits equaling credits at $5,000 each. And in accounting, balance is key. Imagine your business needing a financial boost on February 1, 2024, you secure a $20,000 bank loan, fueling your operations. The cash infusion boosts your assets, increasing the cash account by $20,000. Simultaneously, your liabilities rise with the bank loan payable increasing by the same amount. Remember, we debit cash to reflect the asset increase and credit bank loan payable for the liability uptick. This transaction showcases the balance between assets and liabilities in financial dealings. In essence, this loan injects liquidity into your business, enabling growth and stability. Ever wondered how receiving cash for services impacts your business's financial health? Let's dive into an enlightening example. Imagine your consulting business receiving $3,000 in cash on March 10, 2024. In this transaction, your cash asset sees a $3,000 boost, paralleled by a $3,000 rise in service revenue. Remember, assets increase with debits, while income climbs with credits. This action not only bolsters your cash reserves but also elevates your owner's equity through earned revenue. A simple entry on March 10, 2024, cash $3,000, service revenue $3,000, cash received for services. This financial maneuver solidifies your business's foundation and propels it forward. Imagine your business paying $1,500 for monthly rent on April 5, 2024. In this transaction, rent expense increases by $1,500, while cash decreases by the same amount. Remember, expenses rise with debits and assets fall with credits. By recording this, your owner's equity is impacted through incurred expenses. On April 5, 2024, rent expense debits $1,500, and cash credits $1,500, reflecting how paying expenses reduces assets but boosts expense accounts, reflecting the consumption of business resources. In the world of accounting, compound journal entries add a layer of complexity by involving more than two accounts. Whether it's multiple debits, multiple credits, or a mix of both, the golden rule remains unchanged: total debits must always equal total credits. Let's dive into an example scenario to grasp this concept better. Imagine on May 20th, 2024, your business makes an $8,000 inventory purchase. $3,000 is paid in cash, while the remaining $5,000 is agreed to be paid later on credit. The inventory asset sees an $8,000 increase, while cash decreases by $3,000, and accounts payable goes up by $5,000. This results in a compound entry on May 20th, 2024. Inventory at $8,000, cash at $3,000, and accounts payable at $5,000. Remember, it's all about ensuring that debits and credits balance out. Stay vigilant, as precision is key in compound journal entries. Every business transaction is like a puzzle piece fitting into the accounting equation, ensuring its balance remains intact. Consider the impact of different transaction types on assets equals liabilities plus equity. When assets are exchanged, one increases while another decreases, yet the total remains steady, like when purchasing equipment with cash. In cases of both asset and liability increase, both sides of the equation rise in harmony, such as when borrowing money from a bank. Similarly, when assets and liabilities decrease together, as in paying off a loan, the equation adjusts accordingly. Witness the growth in assets and equity through revenue earned, like providing services for cash. Each transaction tells a story of balance and change within the equation, showcasing the dynamic nature of financial records. Remember, in the world of accounting, every move counts towards maintaining equilibrium within the equation. Ever wondered what a trial balance really is? It's like a financial snapshot, capturing all accounts and their balances at a specific moment. Picture two columns, one for debits, like assets and expenses, and one for credits, think liabilities, equity, and income. The magic happens when these columns balance perfectly. But beware. Even a harmonious trial balance doesn't guarantee error-free records. It's your red flag for spotting glitches in your financial data. Remember, balance isn't always synonymous with accuracy. Keep a keen eye for those sneaky mistakes. Ever wondered how a trial balance really works? Picture this: debit balance on one side, credit balance on the other, both adding up to $50,000 each. It's like a financial seesaw perfectly in balance. This snapshot gives us a clear view of our accounts. The debits and credits neatly organized, showcasing the financial health of our books. It's a crucial tool, ensuring our records are accurate and error-free. This simple yet powerful structure serves as the backbone of financial analysis. So, when the totals align perfectly, we know our accounts are in harmony. A trial balance, where numbers speak volumes. Ever wondered why double-entry bookkeeping is the gold standard in accounting? It's not just about numbers, it's about precision. With every debit matched by a credit, errors stand no chance, ensuring rock-solid mathematical accuracy. But it's not just about the math, it's about transparency. Each transaction leaves a clear trail, painting a vivid picture of financial health for analysis and reporting. And let's not forget about security. The intricate web of interconnected accounts acts as a fortress against fraud, safeguarding the integrity of your finances. From balance sheets to strategic decisions, double-entry records lay the foundation for success, guiding businesses towards informed choices and legal compliance. In the world of finance, double-entry bookkeeping isn't just a choice, it's a smart business move. Ever struggled to grasp the ins and outs of debits and credits? Let's simplify it. Picture a neat arrangement: assets, expenses, liabilities, equity, and income. Each transaction involves a dance between at least two of these. Remember, it's all about balance: total debits must match total credits. With practice, this logic becomes second nature. The more you delve into recording entries, the clearer it all becomes. So, embrace the process, keep at it, and soon you'll navigate financial landscapes like a pro.